Yeah. Hi, everyone. I'm delighted you could join us today. My name is Samantha Taylor, and I'm the head of research at IFI Global. We are very pleased you could join us for the second webcast we have hosted for our private markets risk monitor. And today we are also going to be announcing the launch of our crisis management advice center for private markets. Given the growing number of problems we are coming across in various private market investment strategies, we believe that the recent launch of our private markets risk monitor and now our crisis management advice center are well timed to focus the industry's attention on what is going on and to provide help for people who find themselves in difficulty. We are delighted to be joined by Daniel Strackman, who is the managing director of ANC Advisors and is also a Wall Street veteran with considerable experience in the investment management industry, as well as being the author of a number of books on investing. Also joining us is Simon Osborne, our CEO. We will be giving a presentation for approximately 25 to 30 minutes to be followed by a discussion on the matters that we are raising today. We very much welcome questions. Please do use the Q&A button at the bottom of your screen to raise a point or ask a question if you would like to do so. I will now hand you over to Simon.
Thank you very much, Samantha, and welcome to you all. I am delighted that you can join us today, and I'm also delighted to say that we have people registered to attend this event as far east from us here in London as Singapore and as far west as California. And we also have a good number of asset owners in the audience, particularly from the US and Canada. You are all very welcome indeed. My name is Simon Osborne. I'm the CEO of IFI Global, which is a research and media house based in the City of London. We do a lot of our own research, particularly in the areas that we're going to be covering today. And we have 3 monthly publications and 1 weekly. One of those monthly publications is called The Ned, which is our risk governance publication. And these days, it is very much for asset owners and their advisors, as it is for independent fund directors, which is more of where it started. The Ned, incidentally, is 15 years old this year. And like any teenager, it is getting more and more critical of the world around it, especially how poor governance oversight can be in the private markets. And we really do focus on the private markets. And that is, of course, what we're talking about today. As Samantha said, we're delighted to have Dan Strackman with us, who, as she says, is a veteran of the investment industry. Dan, Samantha, and I are going to take you through the topics you'll see on the screen in front of you right now. And then we're going to have a de facto panel discussion. And as Samantha says, we'd love to get your questions. Please do fire them in when we get to that stage of the session today. Those, as I say, are the topics we're going to be covering. I fear, and I hope I'm wrong in saying this, that they are very well timed given what's going on in the world. And we speak at this particularly critical time in terms of the Gulf crisis. And if you are somewhat bearish, as I certainly am, there is a concern that we could be in a serious market crisis later on in the year. We incidentally came up with the idea of doing the private markets risk monitor before any of the activity, the recent activity in the Middle East begun, but that has made it, of course, more relevant. So why the private markets risk monitor? We felt for a long time that independent oversight has been neglected, not completely neglected, but has been significantly neglected in private markets, where there is, of course, an absence of boards in a lot of the investment structures that are taking place there, and there's been nothing really to put in their place. And we feel that the boom in the main illiquid alt strategies, obviously private equity, etc., is over, and we may be in a situation for a number of years yet before it starts to really grow again, or it even potentially could go down from where it is now. We particularly feel in the emerging asset classes, risk governance is being overlooked for two reasons. When we say emerging asset classes, are talking about both sustainability and in the digital asset world. In the case of the digital asset world, it's because people really don't understand the asset class particularly well. That's part of the reason. In the sustainable area, it's because people tend to lower their standards of risk oversight when they're looking at investment opportunities in that area. So the NED or IFI Global feels that there is a need, and we've sort of attempted to take on the mantle for an independent entity to promote governance standards and offer best practice guidance, which is a lot of what we do now in that publication. What we're going to do now is to give you a sense of, I said that we've been seeing a growth in failures of things that have been going wrong for a while. We only started tracking them properly earlier, beginning of this year. We've obviously were aware of them before this year or last year or the year before last. So we can't necessarily say it's 10% up, it's 20% up on where we were in 2025 or 2024. But we do strongly feel there has been a growth in the last year, certainly the last 6 months, of failures, and we're going to quickly give you a run through of one of those failures that we're picking up on and we're covering now in the NED. So Samantha is the person to really to take you through this. So let's quickly gallop through the examples we've got here, and then we'll come on to the wider lessons, perhaps of some or a lot of these examples. Samantha.
Yes, so here we have four of the most recent failures within private credit. They happen to have occurred within 6 months of one another. So starting with the most recent, as of a couple of months ago, which was MFS. Now, obviously there was fraudulent activity that occurred, but the real issue is that there was a shared reliance on an independent verification structure that was never wholly independent of MFS. Now, according to Unicus Investors, post-mortem analysis of the failure, MFS retaining control of the whole collateral pool was fully visible in all public disclosures. It just wasn't looked at properly. And moving on to HPS Investment Partners, this is obviously the private credit arm now of BlackRock. This is a similar thing. It's a failure of verification structures. This time it was failed due diligence and auditing and of collateral invoices. This was as simple as missing that email addresses didn't match purported clients of Brandbat. So it's a real easy thing to spot. It just wasn't done. And then obviously you have Tricolor and First Brands. But what I want you to take away from this is that you cannot think of these four instances as, individual cases of fraud. It's not. The fraud has just uncovered systemic governance failures within private credit. Now, moving on into real estate, we obviously have a collection of German pension funds. BVK is obviously one of the largest German pension funds. They unfortunately have written down several losses tied to direct US real estate investments linked to Deutsche Finance America and a New York developer who has been convicted of fraud previously. Hesson Lawyers, again, this is a relatively small pension fund in comparison to BVK. They have also written down 58 million euros in losses tied to similar US real estate investments. Babcock, now this is in relation to failed European real estate investments. And finally, we have Alecta, which is obviously a large Swedish pension fund. They have been fined by the Swedish regulator over significant risk management deficiencies in association to its $4.7 billion investment into Swedish real estate company. Now, finally, we have governance failures. We have a US pension fund, the Iowa Public Employees Retirement System. Now, they are currently facing a significant lawsuit and investigation brought by the former investment risk officer. It is alleged that there are significant governance failures, including deliberate deception of the board as to the financial position of the fund, risk management deficiencies, and irregular investment reporting practices. Then moving on, recently we have spotted a rise in claims under the Employees Retirement Income Security Act. Obviously, Franklin Templeton, Stifel Financial, Bloomberg, etc. These are really alleging breach of duty for retaining underperforming funds within 401k plans.
Before we got some more, but Dan, do you want to comment on anything here on this page in terms of the point that Samantha made? People tend to point out these as being specific problems in specific situations, but they also have maybe a broader connection between them all.
Well, I think that, Simon, I think that in reality, what this, I don't know if there's a chart, let's call it a slide. What this slide shows us all is that there's a lot of issues across all asset classes, all structures, and things that it seems that in general people should be thinking about how their money's managed, but in reality, they're just making comments or doing things that aren't correct. I mean, the biggest this ERISA stuff is very fascinating because now you have big issues with 401k plans here in the U.S. because we've gone from, defined contribution plans to plans that are self-funded, and so it's a big issue for people, and it's something that people are talking about. The other issues, quite frankly, I mean, how is it possible that Carlyle, Apollo, and BlackRock are having these problems? Right? I mean, how is that possible? You've got three of the largest, one of the largest money manager in the world, and two of the second, in the top 20, if not top 10, and they don't. You're telling me their operations are failing? I mean, how is that possible? Where is the outrage? Where's the outrage? So, but look, you can't. Money is a funny thing, and people act. Do bad things. I don't know.
Well, the theme of this, and we've got more to give yet, is that all these problems are swept under the carpet when the investment is going well, and we've been through this big bull run for a long time. When the performance isn't great, that's when the problems emerge. All right, sorry, Samantha, and far away, we got other examples here on the screen.
Yes, so
Visa
B is one of the most egregious failures, I think, of recent times to do with the pension fund. So Visa B is a relatively small German dental association's pension fund. They did have total assets under management of around 2.2 billion euros. They have unfortunately wiped out 1.1 billion. So half tied to failed private market investments. According to Bloomberg, they had more than 70% of their total assets invested in private markets, into a German shrimp farm, a Californian recycling firm, an insurance startup, a handful of European luxury resorts as well. They are currently seeking legal action against their former auditor, Forvis Mazars, their advisor, Apo Bank, and 9 current and former committee and board members for significant failure and breach of duty. Moving back on to MERS, which is obviously the Michigan Employees Retirement System. Now, this failure is in relation to their direct investment into a Hawaiian coffee farm, Kona Hills. Yes, unfortunately, that did fail with losses totaling $86 million. This does not include a $40 million lawsuit from an agricultural lender. Moving on into renewables. You currently, in the UK, you have a current case going through by Aberdeen City Council on behalf of the North East Scotland Pension Fund against Hermes Infrastructure. This is in relation to the manager failing to manage and identify material risks associated with the core portfolio of 5 Swedish wind farm assets. They alleged that the assets were not suitable to be within a core portfolio because of their reliance on baseload power purchase agreements, which then exposed the portfolio to significant downside risk to the extent that the portfolio devalued significantly from £104 million back in 2019 to just £17 million as of filing in September 2025. Now, Michigan Employees Retirement System is back on the list, this time in relation to they failed to identify conflict of interest in relation to a renewable energy fuels investment with a Swedish asset manager. The conflict was only spotted when a new asset manager was brought in relation to the failed investment with Kona Hills. Was that conflict of interest then spotted, with the two principals allegedly misappropriating pension fund capital to recover personal investments. Now, we have the AP funds. This, again, they're currently under significant investigation in relation to their failed investment into a battery manufacturer, Northvolt.
Can I just jump in there for anyone who doesn't know? It's a bit like Dan's point a second ago. This is huge in Sweden. In Sweden, these are public pension funds. There are 7 AP funds, and a lot of the Swedish public have their money in the AP1 to AP7. And these aren't little tiny little pension funds. These are very well funded, large pension funds that were early allocators into alternatives. Sorry, Samantha, just to...
Yeah. So the investigation found that they deliberately sought to circumvent domestic legislation, which expressly prohibited them from investing in this kind of asset. Went ahead and did it anyway, and failed to spot the conflict of interest with McKinsey and the CEO of Northvolt. Then we come to Ireland with Arena Capital Partners. It was found by the examiner back in September of last year to have had significantly overstated value of wind, solar, and social housing assets, as well as deliberately not including a significant amount of debt from the balance sheet. And then Thurrock Pension Fund is in relation to a failed solar farm investment. Simon, you know more about that, don't you?
Yeah, there's a friend of mine who's and this is where we originally started picking up on a lot of the things that were going wrong in the UK, who was the one that uncovered that. And that story, which mostly, by the way, most of these frauds, this is an important point to make, never get into the public arena at all, because everyone, whether you're on the pension fund or wherever LP side you're on, you don't want that getting out there. And of course, the manager stroke GP doesn't want that getting out there, and it's all swept under the carpet. It's very difficult for us, the risk of lawsuits, to write anything about it. So by and large, we can't. You just have to take our word. We hear a lot more about things going wrong than we're able to publish. But Thurrock was one we really could go to town on, because not only the Financial Times, but even a mid-market newspaper here in the UK called the Daily Mail, which is more interested in writing about where the Beckhams went on their summer holiday. They had a big splash on that. It was outrageous. It wasn't necessarily fraud, but the Thurrock, which is a local county council in the same county that Samantha lives in, which is Essex, lost a ton of money to somebody that made millions of pounds out of putting them into solar farms. They didn't really know what they were doing. Is that a fair summary, Samantha, in one word? Because we've got to get on, crack on, because we'll be running behind. But it's quite incredible. But as I say, Thurrock actually was a couple of years ago, but most of these are really they're current stroke, very recent. And I would lay a large bet with anyone who wants to take me on. If we were doing this in 6 months' time, we would have even more examples of things that we don't know about today coming up. Right. Finally, on our examples, then we're moving on into other areas of this presentation. So back to you, Samantha.
Yeah, so Cushman and Wakefield is quite a precedent in the US currently. It's obviously an ERISA claim brought by a former employee alleging that the Cushman and Wakefield is failing to adequately assess and manage and identify climate risks that relate to its 401k core fund. They also claim that it is majorly underperforming its benchmarks as well. So it's a real breach of duty claim. Then we've got the Canadian Pension Plan Investment Board. They are currently being sued by beneficiaries for understating climate risks and having subpar climate risk assessments. A similar action was brought against one of the largest UK pension funds, USS, which ultimately failed for derivative action. Then we have the recent Association of Chartered Certified Accountants report. They have issued a warning that sustainability risk is a material financial risk, but consequences are already being seen on balance sheets for failure to identify and manage climate and nature related risks. Then finally, we have directors' duties. So following legal opinion in the UK, New Zealand, Australia, and Canada, Norton Rose Fulbright has suggested that nature risks are material risks, so are well within the scope of directors' obligations. Going forward, you may see action brought against directors if they mismanage nature-related risks to the detriment of the company.
Yeah, there's going to be a lawyer's feeding frenzy coming along in nature risk in the near future. There's going to be so many laws. It's so difficult to define that, but I guarantee you that's on its way in the near future. Is that it for this page, right?
Yes, yeah.
Right. So I want to quickly talk about something else which we're very conscious of, or become conscious of recently anyway, which is co-investment and structuring issues and the risks that they pose. And it's one of the large reasons why there's been so many problems in private markets. It's because of the growing complexity of the structures that are being used. And the most prominent part of the diversification of structures has been the co-investment boom. And within the co-investment boom, there's different types of co-investments, as you're doubtless all well aware of. It's the growth in investment and fund structuring complexity that has made it a real governance oversight challenge. That, I think, Samantha, you would agree is, if you look at the MFS, which is the current case going on here in the UK right now, the private credit thing, that was so incredibly complex, unnecessarily complex, probably from a fund structuring point of view. Would you say that?
Yeah, I mean, the use of warehouses is not abnormal within private credit. However, the fact that they picked two different service providers meant that either one, Intertrust and TMF Group, could not see the whole chain. So it wasn't spotted, essentially.
Right. And co-investments, as I'm sure everyone here is aware, require more commitment, monitoring skill, and experience. And the point is, and this goes back to what happened in Thurrock, which I'm too familiar with. The LPs, and more importantly, their advisors. The LP normally isn't the LP in the Thurrock County Council pension fund people obviously aren't specialists in renewable energy, but they pick somebody who they think is, but isn't. Is in blunt terms, and that's what's been going on. Quickly, because I'm very conscious of the time, co-investment risks, which is what we're already saying, is if this direct exposure to investments like these, some particularly in sustainability, there's been a big growth in co-investments into sustainable things like the Thurrock example with we're talking about, but also the coffee farm in California, not California, in Hawaii, wherever it was. There's so many of these things are causing the investors trouble because they just don't know enough about it. And then the other thing about co-investments are the hidden fees. Dan, do you want to say, do you get involved at all with co-investments and structuring?
Yeah, absolutely, Simon. I mean, look, first of all, where are the lawsuits against, was it Vistra and TMF for the MFS failure?
Intertrust.
Oh, Intertrust, same thing. I mean, they're rinse and repeat these funds. I mean, this just shows you the failure of third-party fund administrators and third-party fund or co-investment administrators. There's no oversight. They're all dying for business at this time. They're all being pushed by their PE masters, and at the end of the day, they're probably excited to get this client, but where's their oversight? Why are they not working collectively to understand what's in the portfolios, what's not in the portfolios, what's being double billed, etc. And if I was I recently, Simon, and Samantha, I'm not sure I told you this, but literally Monday, I was appointed to be a trustee of the City of Parkland, Florida Police Pension Fund. And my job there is to be a fiduciary and make sure that those assets are invested correctly, and meet the actuarial tables that are needed to make sure that the police who are charged with keeping my city safe are compensated for that work that they're entitled to, right, when they retire. And so that's the real issue here. The real issue is the directors, the trustees. They need to be getting involved, and if these to make sure that the fund itself is doing what it's supposed to be doing, to make sure that they have the assets that are needed to pay out their pensioners or even their LPs when the time is right or the time comes. And there's a real lack of fiduciary oversight because people want to, it's glorious to be or glamorous, not glorious, maybe glorious too, but glamorous to tell people that you're a trustee of a pension or you're on the board of a fund. But the reality is, at the end of the day, a lot of these people are, burnt out fund accountants, they're burnt out lawyers, they're burnt out, people who never really understood how money is managed, and they're taking on a fiduciary duty role without really understanding what that means and what they're supposed to be doing. The co-investments, we have a number of funds that do that. I'm on the board of a couple different funds that do use a co-investment structure, and I think what's interesting about the way they do it is there is complete transparency, right? And I think that's what we're calling for here, Simon, and that's what we're looking for, and what you're basically saying. I mean, how can there be hidden fees if there's complete transparency? But the reality of the situation is it comes down to the LP to ask the IM or the GP, what is being done with my money? How is it being done with my money? And let me see the audit. Let me see what's happening. Let me talk to, the person who's picking the coffee and roasting it. Let me, but at the end, that's something that these LPs don't want to do. They want to set it and forget it. It's a rinse and repeat. And frankly, Simon, I think you're spot on when you said, 6 months from now, we're going to have more failures. Because as Mr. Buffett said, when the tide rolls out, we see you swimming naked. And that's what we're seeing now. The tide is rolling out. We are in a global recession. I don't care what the IMF says, what the president says, what Mr. Starmer says, what anybody says, that we are in a global recession. And the reality is things are going to get bad before, get worse before they get better. And we can't be fooled by equity markets that just continue to run. There are a lot of issues here, and I think that people need to prepare themselves for dealing with that. And that's why this is such an exciting product that you guys are rolling out. And it's really brilliant idea to do this, because you're basically saying to people, look, we want to help you avoid getting put into these crisis situations, but more importantly, we want to help you deal with them when you are in these crisis situations. And I would say to those who are on this call, and I know there's some of our friends that were on this call from the IMDDA, great members of the IMDDA who are on this call, and a lot of your readers, obviously Simon and Samantha, are on this call, and maybe a lot of random people are on this call. But this is a time to start paying attention. Okay, this is not a time to be thinking about summer holidays, or where the Beckhams are going on summer holidays. Although I'm very curious where Mr. Beckham will be. But the reality is, this is the time. And Simon, you guys are spot on in the way you're thinking about this. We see it every day. So and investors, LPs, they cannot put their head in the sand. They need to be thinking about these issues today, focusing on them today. Because if you own a coffee plantation in Hawaii, and you don't think that's going to blow up, you should number one, you should quit your job today and go do something else. But number two, you should go to jail, in my opinion. I mean, there's no question in my mind that these people should be in jail. especially when they're stealing basically from people who work hard, whether it's a police or fire person, whether it's someone who's on the railroads, whether it's someone who's a teacher, or whether it's the janitor in City Hall. When we're talking about the MERS situation specifically, these people who are supposed to be fiduciaries should go to jail, and they should be stripped of all of their assets to make sure that these pensioners get what they deserve, because they did their job, and these people aren't doing theirs.
That's quite a powerful statement. So let's move on to.
Sorry.
Oh, fair enough. Fair enough. Let's move on to the lessons that have been learned. In fact, we've already been covering this to a certain extent, but clearly what we've been saying, if you haven't already got it already in 100 different ways, is LP direct exposure to assets they don't fully understand. That has been the big growth. We've been through this huge bull market. You can argue about when it started, 2010, 12, 13, 14. It's went on until whenever you want to say it ended a year or two ago in the private markets. Dan says we're already recession. Let's say he's right. It went on for a good solid 10 years, whatever. But we're not in that situation today. But a lot of LPs have had direct exposure to things they don't really, truly, fully understand because they hired advisors who don't really understand it. Structuring complexity, we've been through that. Let's don't say anything more about that. Oversight obligations, again, that's really what Dan's been talking about. But Dan, do you want to say do your job? Is the message there, isn't it? Really, which they haven't been doing, you claim.
Oh, sorry, I didn't mean to interrupt you, but yeah, it's more than do your job. It's get your feet wet. It's get your hands dirty. It's get into the weeds and understand what's happening with the money. You have an obligation as a trustee, as a director, to ensure that the fund is being managed to the way it's supposed to be managed based on the decision that was made when you invested in it. But I think, it's funny that you have this line from 2008 in there. I don't know if any of you know this, but today in the market history, the Wall Street Journal, not to give them a plug, but the Wall Street Journal every day puts out something called market recap or market update. I don't know. I get it every morning, and they are at the bottom. They have something called Today in Markets History. Well, today, ladies and gentlemen, in 1999, before Samantha was born, I'm sure, and well into my career on the street, is the day that a little company called eToys went public. I'm just reading. That's why I'm looking down. Went public. Was supposed to go out at 12. Went public at 20. Boosted up to, or ran up to 83. Settled in at 76 with a 282.8% return on day one, and just a short year and a half later, bankrupt. So this is the problem, right? This is the problem. We are not, it's 1999 all over again. It's 2008 all over again. It was 2017 we had issues. Here we are 10 years later or so, and we're back in the same soup that we were in all those different periods. And the reason for this is twofold. One, investor or LP apathy, and two, FOMO. There's a lot of FOMO that people, and for those who don't know what FOMO is, it's fear of missing out. There's a lot of that in the market, but there's also one other thing that nobody wants to talk about. And I'm not going to apologize, Simon, to you or Samantha or any investment advisor who's on this call. But these investment advisors, whether it's the big pension consulting firm up in New England, whether it's the big pension consulting firm that runs something called the Village in London, whether it's McKinsey, which you've already mentioned, whether it's any Watson Wyatt, whether it's the other firm in Connecticut, these people are selling pension plans a bill of goods. They're basically selling them a bill of goods saying that we're going to create a customized portfolio of what they're doing and what your investors should be getting into, or what you should be investing your money in. I didn't say that correctly. And at the end of the day, we learned this in 2008. We learned it in 2008 that this was all, to use a great term from the English language, hooey. They basically took the same thing and sold it to different people, telling them, to use another great English language, that they were creating bespoke portfolios. And that's how we ended up in the situation we were in 2008. I would suggest, Simon, we're ending up in that same situation that we in 2026, 27. And Samantha, to your point earlier, I think that's exactly why people are buying coffee farms in the middle of Hawaii, because they're experiencing FOMO, and these investment advisors are blowing their own fiduciary duty to say, we're going to tell you, Mr. and Mrs. Pension Plan advisor or trustee or whomever, that you should be buying these products because everybody else is doing these crazy things. And whether it's a wind farm, whether it's a solar farm, whether it's a uranium plant or a mini nuclear power plant, I mean, whatever. And that's it. That's what's happening right here. We're going to bust. I'm telling you right now, mark my words. I'm happy to say it. I've been saying it for a while. May 20th, May 20th, 2026. The bust is coming, ladies and gentlemen. And it's the job of it's not just the advisors, by the way, who are the people who are going to be responsible. It's the trustees, it's the directors, it's the investment managers who are also going to be responsible. And yeah, it's coming. It's coming.
Well, quickly moving on, because I'm conscious of the time. We've still got more to go through. So basically, this is a subject I've been banging on about for a long time. We won't get into this really now, but we really think risk governance needs to be more forward-looking. It's not about just checking the VaR numbers are right and they've stayed within the risk parameters they should be. I have got to be in my bonnet about that, because you look at the people who go into fund management, they tend to be people who are extremely good at maths, but they have as much knowledge about what's going on in the world as I don't know, our cat does, in Sarasota, Florida. They have no knowledge about how the world works, but they're phenomenally good at doing the mathematics. And where Samantha and I went to university, which is a place called the London School of Economics, you've got to get not just an A star in maths, but an A star in further maths to do economics these days. But you don't have to have any kind of a qualification in common sense or any kind of knowledge about what's going on in the geopolitical world. So I'll stop that there. Now, the reason we put is this 2008 coming round again is because I'm old enough to remember the boom and then the crash that happened in 2008, and the fallout, which didn't happen in 2008, happened though the ensuing few years, and there was a lot of angst and but the independent oversight function in the investing world back then, very different investment world from today, much more on the alternative side around hedge funds, and a lot of the focus of that was in Cayman at the time. But there was a lot of misery, and there were a lot of bad situations that came about. And I wonder whether or not, because there's been definitely, in the way that the private market structures have been developed, absent and outside the whole board area, has meant that the independent oversight has been neglected. Whether or not we're going to see something, it'll be a different type of thing, but something of the similar nature coming up if Dan's right and we're an Armageddon or bad things are around the corner. So here at IFI Global, I should say, the NED, our publication, we're looking at this in 3 streams. The illiquid alts, the traditional illiquid alts, obviously the PE and the private credit, the infrastructure. The big one coming up rapidly on the rails is the data centers. I could talk all day about that. We've been doing some work on data center risk, which is enormous. And a lot of people have been piling into that through their real estate portfolios or their infrastructure portfolios or whatever it is. But that's being a big growth area, a highly risky area. But that's part of category 1. Category 2, we have a sustainable investment publication called SII, which is going very well, but we do worry about some of the risks in sustainability if you don't know what you're doing. And a lot of people, there's been 80%, Samantha, I can't remember the figure, 80% of the investment into natural capital is coming from the pension funds, I think, or something like
Pretty
that.
much.
It's a huge number, and the rest is probably coming from sovereign wealth funds and family offices and whatever else. I do wonder whether or not the risk factors have been totally taken into account there. And the third one is digital asset management. That's another world unto itself. We've done a lot of work on the development of tokenization into private markets. We haven't really got the time to get into that today. We could have a whole separate session on that, but that is there too. There's been growth of that. There's been tremendous growth of stable coins in the last couple of years. We did a white paper on that quite recently. Rapidly moving on. We said at the beginning, we haven't really talked about it since the beginning of this presentation. We are launching now a thing called the Crisis Management Advice Center, particularly for private markets. There's two reasons for doing it. The first one is to help investors in private markets when they run into difficulty and to be an independent source of information on that. And the second reason for doing that is to provide directors of private market investments, not just funds, but anyone to do with private market investments, with information to help them steer their funds through the difficulties. And going back to the 2008 period, not necessarily 2008, but in the 2 or 3 years after that, in the very early days of the NED, we did put people in touch with each other, and they found that very useful to be in touch with each other, people from different jurisdictions in different positions who found they have sharing their problems was very helpful. If we are going into a bleaker period in the future, something like that we hope will be useful again in this current environment. But certainly we don't think, and Dan and I have spoken about this a number of times now, and please chip in here, Dan. We don't think there's anything in the market. You could come to Dan, ourselves, and talk about, share your problems, and we will give you independent, utterly independent advice. We've got no other skin in the game, and we'll try, and we might have come across situations that you're in other situations. Dan, would you like to chip in?
No, I mean, look, we're always happy to talk to people and always happy to give advice, guidance, and support to folks who are dealing with difficult situations, as well as help them, strengthen their existing operations or existing duties, or the existing duties they're providing in order to help them potentially avoid these types of difficulties. So, yeah, we're here for you if you need it, and looking forward to helping people through the difficulties and dealing with the issues.
Okay, great. Lastly, before we have see if we've got any questions or anything like that, is we slightly separately but connected as well, we have at IFI Global, not just at the NED, but at IFI Global, including the NED, we've launched a thing called Interactive Market Intelligence. These are it's offering bespoke advice, guidance, research, including on those topics listed on the screen there. These are all areas we feel we have expertise and knowledge and do research in all the time. And if anyone in the audience wants information on that, we've got a lot of data information, like to think knowledge on those areas. So please do get in touch with us if you'd like to know more about that. Right, so I'm going to stop sharing screen and see whether we have any questions. And Samantha, if you've got any questions you'd like to read out?
Yes, we do.
Okay.
So the first question is, why do you say independent oversight has been neglected? There are lots of advisors around.
You want to go first on that, Dan?
Well, first of all, it's been neglected. We're not saying it. We're showing it, right? We're proving it. So that's number one. Number two, yes, there are independent advisors, and there are folks who are charged with those duties. But those are also similar to the duties that that a third-party administrator gets charged with, as well as a fund accountant gets charged with. And the reality of the situation is all those people are getting paid. And who are they getting paid from? They're not getting paid from the LP side. They're getting paid from the IM side. And so, or in this, the pension fund management team. And so that's an inherent conflict right there. But I do think the reality is we're not saying it, we're showing it. And Samantha laid out beautiful examples of where the independent advice has failed dramatically.
Yeah, I add to that only that I don't know if there always are advisors. I mean, one of the things that we come across, particularly when it comes to the sustainable sectors, and we're asked about this every now and again, there is no, or sometimes there are no independent directors on the boards of these funds. And if you ask the manager as to why that is, they say, well, we would like to, but there's no one. We can't find anyone who knows anything about what we're investing in. And in some of these areas, you really do need to have specialist knowledge. If you're going to be going into renewables, you need to have almost some engineering capability, perhaps. You certainly, it's not like being, with all due respect to any fund accountants in Dublin or Luxembourg or the Channel Islands that may be on this call, it's not like doing the traditional fund back office job to be on the board of these funds, because you're not adding anything in that situation. And that's the problem. And that needs to be a rethink from the governance of the oversight of that. And ditto in a very different way in the digital world. If you look at the boards of digital funds, there's again, they don't want the traditional back office directors that are in some of these jurisdictions, Cayman Islands, Dublin, Luxembourg, wherever, because they want people that understand what they're doing, and it's highly complex. If you're not that digitally inclined, you're probably not going to be up to speed on it, and that's the problem there. So they don't all. I don't know if there always are advisors, and that's part of the problem. And when you get into nature, it's a highly. Samantha knows 100 times more about the world of nature investing than I do. It's very complicated, isn't it, Samantha? I mean, you get an example. There's over 2,000 bits of metric in nature investing or something like that.
Yes, yeah, there's lots of things to consider when you make an allocation to, like say, even agriculture. Um, mm.
Okay, so that's I'm rethinking I suppose the bottom line is rethinking how advice is done. Independent advice is badly needed. Next question. The other you said there's no.
How can risk governance be made more forward-looking?
Yes. Yeah, I mentioned that a minute ago. Again, good question. It's not just a matter of just ticking the boxes and putting VAR numbers in. Dan, have you got any thoughts on how it could be? Do you think it should be more forward-looking? And how much time is on risk management to your board meetings?
Well, look, I think there's a couple of different things here. I think number one, you touched on it, Simon, and I think I mentioned it also. I mean, bringing on a director or a trustee that is sitting in the sand sipping a pina colada in Cayman and signing documents on an iPhone is not bringing in oversight. It's not bringing in governance. It's not bringing in anything other than someone whose name can be in a book. And the reality is, I think that managers as well as LPs should be engaging folks who have the skill set that is needed to make sure that the IM or the pension manager is doing the right thing with the assets. But too many times, the LPs don't even know that there's board of directors for a Cayman, BVI, Jersey, Guernsey, Lux, whatever fund. And that's a failure of the investor. It's a failure of the LP. So I think that the LP needs to really start thinking about these issues and then really demanding that their managers are doing the right thing by them, and not deal with FOMO, so to speak. Say we don't care about FOMO. We're willing to miss out if you can't do what we want with to make sure that things go correctly.
I would just add to what Dan was saying there, that is a specialist subject of mine, and bee in my bonnet's been in this way at least since the Ukraine war started, and things, if anything, have got more geopolitical ever since then, notwithstanding the current situation in the Gulf. But I am surprised there are a lot of geopolitical think tanks, entities, especially in the US, in Washington, D.C., a few in New York. There's a fair number in London. There's probably countless other ones in other places too. I'm really surprised that boards do not subscribe. This is traditional fund boards now, do not have any kind of interaction with those entities in any way or form. Why aren't they delivering reports on what's going on in the world to a fund that's for a quarterly fund board meeting? I don't know. Very, very little to non-existent contact is going on. So that would be one way of gravitating a bit of the discussion on the risk management side to something more forward-looking, and to get the directors of the fund to sort of think in a more holistic way about what would happen if Taiwan got invaded tomorrow, or if it was just if the Chinese just just close it down without invading. What happens if the chips from Taiwan couldn't get out for whatever reason? What in that kind of what if scenario, how does that affect our fund sitting in New York or Chicago or London or Timbuktu? What does that do? How much of that what if game playing is done at board level? Dan, you'd probably know better than me. Do you ever get involved in those types of discussions?
We absolutely do. I mean, I think that comes down to, though, Simon, the quality of the director and the quality of engagement by the director. And I think the biggest issue with directors today is, number one, there's a ton of people doing it. Number two, most of the people who are doing it are completely inexperienced. And number three, most of the people who are doing it who are inexperienced are afraid of asking questions, afraid of doing, of getting involved. They don't want to get their hands dirty and their feet wet, because they don't want to lose the assignment. It's very prestigious to want to run around and tell people you're a director of a hedge fund or a mutual fund or a PE advisor or something like that. And they don't, and they believe that they want to grow a business doing that, but they're more concerned about maintaining their appointment than they are with asking, okay, how's the fund going to deal with the fact that we just invaded Iran, or we're going to, like you said, the chips aren't coming out of Taiwan, or the supply chain issues come around, or the Ebola spreads, or the Hunter virus spreads. I mean, how is the fund positioned itself to deal with that, and what is the impact of those sort of geopolitical situations going to be on the fund, and then in turn the investors? I think that on a few of the boards that I sit on, we talk about this stuff all the time. On a couple of the other boards I sit on, we talk about also the regulatory changes. What's happening in Washington? What's happening in the UK? What's happening in the EU? How are regulatory changes affecting the way the fund is being managed, the way the fund is being run, and what levels of additional infrastructure are needed. And those are the questions you have to ask. Directors need to be involved, Simon, and they don't want to be because they're afraid of losing the appointment, right? I mean, this is why people sit on boards. They want the money. By the way, Simon, I got to tell you, what's really been bugging me for the last half hour, I need to ask you about. It sounds like you got a lot of bees in your bonnet. I mean, whoa. I mean, I'm worried about you.
I was thinking of the other way around, actually.
Yeah. So, I mean,
I think we should probably wrap this up if we're going to get into bees and bonnets, we should probably.
Are there any?
We've got another question, have we, or not?
Yeah, we do.
Yeah. Let's answer the questions.
Yeah. How is your crisis management advice center assessed?
Sorry, how's the crisis management center what?
Assessed.
Assess.
Yeah.
I mean,
access. Sorry.
Oh, access. It's 1-800 dial Simon.
Access. Well, the best thing is if you send either Samantha or me or Tamara Sims an email. Samantha's email is just her last name, taylor@ifiglobal.com. We can answer that, but basically it's at the very basic level we can give information to our subscribers without charge. If you want to go to the next level, then we can start talking about whatever that is. But certainly these are services we're trying to, as much as possible, we're trying to add on to our subscribers. And the same applies to the whole information we're doing in terms of the detail we're putting out on risk as well. As much as possible, these are things we add on as part of the subscription to either the NED or one of our other publications. And so,
right.
Is that
final question.
What?
Final question.
Yeah.
Do you have any resources that you can point me to that includes best practices for building a stronger, forward-looking risk management governance structure, or contextual information when assessing a fund or PE offering structure?
Oh, please call me. I'll help you with that.
That is definitely for Dan. Who?
Oh my goodness, that'd be brilliant.
Can you make a note of that name, Samantha, and we'll give Dan. Dan is your man. That is
We would be happy to spend some time with you on.
that's what he does. That's what he does. So he's if you please pass that on to Dan, yeah, that'd be great. Well, listen, I think we should wrap it up. We've done nearly an hour. Thank you very much, all of you who are still here, which is a good number of you. Thank you very much for joining us today. We hope to do these things again in the future. We certainly will. It's a question of when. And let's all hope that Dan and I are wrong, and it will be a lovely, fantastic bull market going up from here. And we don't have to worry about independent governance and risk and all those boring things like that.
Simon, I just want to ask one question of you and Samantha. I know we might have covered this earlier, but this podcast, webinar, whatever you guys call it, we just call them webinars here in the US, but you guys name them different things. This will be available, right? So we're going to be able to share this link with folks, because I think this, I would encourage anybody who's listening to grab that link when it's available and share it with all their colleagues, their friends, their neighbors, maybe some of the bees in Simon's bonnet. But I really do think this is, with the topics that were covered today are really front and center. And quite frankly, Simon and Samantha are the only ones really talking about this. They invited me on for the color and because of my nice, looks. But the reality is that these guys are the only folks talking about these issues. And this is something that if you are in one of these pension fund groups where you're talking to other groups and or other pension plans and family offices or whomever, you really should share this information, because what Simon and Samantha and Tamar are doing is just spot on, and they're the only ones talking about these issues, right? So,
well, let's hope they don't need to. Maybe we're the unnecessary doomsters out there. All right, chaps. Thank you Dan. Thank you very much. Thank you very much for all of you who've been following us this afternoon. Have a good morning, afternoon, or evening, no matter where you are in the world. Bye-bye, everybody. Bye-bye.